Welcome back to the deep dive. Today we are strapping in for a deep dive that goes straight to the heart of the U.S. energy grid's massive transformation. Our mission isn't just to quickly look over the Q3 2025 financials. It's really to track the billions in growth capital expenditure, the CapEx, and figure out where that money is physically, well, reshaping the landscape, especially around long-term contracted demand.
Yeah, it's absolutely critical to look past the quarterly ticker tape, as you say. I mean, these numbers, they confirm stability, sure. But the real story, that's in the organic growth projects. We're talking new pipelines, new storage facilities, and crucially, all backed by these non-commodity exposed long-term contracts. This is infrastructure being built for the next, 2 decades, not just the next 2 quarters.
Okay, right. So let's quickly frame the financial stability that actually makes all this possible. Adjusted EBITDA for the quarter came in at $3.84 billion. Now, that looks kind of flat year over year if you exclude some one-time asset sales from last year, but it really demonstrates remarkable resilience, doesn't it? Especially in today's volatile environment. And the distributable cash flow, DCF, that's the money available for shareholders and reinvestment, it was strong too, around $1.9 billion.
Exactly. And that flatness in earnings, it's not stagnation. Not at all. It's actually a sign of a massive, stable foundation. That's what lets them allocate capital so aggressively. And if you want proof of where the velocity is, just look at the operational records. They absolutely crushed this quarter.
And there were quite a few records, weren't there?
Oh, indeed. We saw record volumes basically across the board. Midstream gathering, NGL transportation, terminal volumes for NGLs and refined products, and maybe most telling, NGL export volumes surged. But the real engine, the one screaming the loudest, that's the Permian Basin.
Yeah, the Permian engine is definitely screaming. Midstream gathering volumes there specifically were up, a remarkable 17% year over year. That's a direct result, right, of those processing capacity additions finally coming online. That volume surge is the market signal. It's telling us where future investments simply have to go.
Precisely. And that high velocity brings us right to the first, and I think arguably the most exciting growth story here, the creation of, a new natural gas economy.
Yeah.
Almost entirely driven by stable new demand. We're talking power generation and, the overwhelming constant energy appetite of data centers.
Okay, let's unpack this shift a bit, because this isn't the old model, is it, where you just build a pipeline and kind of hope producers show up and fill it. This is what they call demand pull, right?
Right.
Real industrial growth, where the end users are signing contracts first.
It completely flips the risk profile. It really does. In just the last year, this partnership locked up over 6 billion cubic feet BCF per day of pipeline capacity. And specifically with these demand pool customers, utilities, huge industrial users, and yes, data centers, 6 DCF per day, that's enormous. For context, that's roughly 7% of the entire U.S. current daily dry gas production.
7%. Wow, that's a staggering amount to lock up for new capacity. What kind of commitment are we talking about from these customers? Is it just like a year or two?
Try 2 decades. The weighted average life of those commitments is over 18 years. That kind of tenure, it's a powerful statement about how they see energy certainty, and it totally de-risks the capital investment. They expect these contracts alone to generate over $25 billion of guaranteed revenue. And that's just from the firm transportation fees over their life. It's take or pay. Customer pays whether they use the capacity or not.
That security gives them the confidence to build big then. So who exactly is writing these enormous checks? Can you give us some specifics on the contracts really driving this?
Well, you can't get a more blue-chip anchor tenant than Oracle, really. Yeah. They signed multiple long-term agreements to supply natural gas to 3 big U.S. data centers. Yeah. 2 of those are in Texas. We're talking about approximately 900,000 MCAPs per day. That's 1,000 cubic feet of supply. And construction's already underway on the lateral pipeline needed to connect them. First flow expected by end of 2025.
That's a really quick turnaround, isn't it? Connecting a major customer within about a year.
And it's not an isolated case. We also saw Fermi America sign a 10-year exclusivity deal. That's for about 300,000 MME2 per day, million British thermal units, the energy content measure to their hypergrid campus near Amarillo, Texas. Plus, there's a more traditional but still very long-term deal, a 20-year binding agreement with Entergy Louisiana. That's for 250,000 MMBtu per day of firm service starting up in December 2028.
What's interesting here, too, is that the high return often comes from relatively low capital input, right? They aren't necessarily building entirely new multi-billion-dollar pipelines just for one single data center.
That's absolutely correct. The returns look phenomenal, partly because many of these data center supply projects require, relatively low capital outlay. Often it just involves laying laterals, smaller connector pipes off their existing massive large diameter pipelines. You basically leverage sunk costs to capture brand new high value demand. It's an ideal economic setup, really.
Okay, so this huge pull from power and tech is now demanding massive new arteries, both interstate and intrastate. Let's pivot then to the two new giant pipelines. The sheer scale of what's being built to support this new economy is something else.
Right, let's start with the Desert Southwest expansion. This is a big one. We're talking 516 miles of 42-inch interstate pipeline. This asset will provide 1.5 BCF per day of capacity, pulling gas from the Permian and pushing it west towards Arizona and New Mexico markets.
And they secured the anchor capacity for this pretty much immediately, didn't they?
They did, yeah. The project is already fully contracted. And these are 25-year commitments with investment-grade counterparties. Solid? But what's really noteworthy is the sheer excess demand they saw. Apparently, there was significantly more interest than they initially planned for. So now they're already evaluating options to increase capacity further, potentially up to 2.5 BCF2F per day total capacity.
Wow. That's a huge oversubscription signal from the market. When's that initial capacity coming online?
The projected in-service date is currently Q4 2029. But, and this is smart, they're thinking way ahead strategically. They've already locked in the price for the actual steel pipe itself. For Q4 2027 delivery, that means they're securing supply and managing long-term project costs against potential inflation. It's crucial for hitting those expected returns.
Very smart. Okay, now for the pipeline that management seem, well, particularly excited about, the Hugh Brinson pipeline. This is the intrastate giant. Phase I construction is already underway, right? 400 miles, 42-inch pipe, running from Waha out to Maypearl, which is near the DFW Metroplex. Management actually used the phrase, the most profitable asset we've ever built. That's quite a statement.
That is a massive claim, especially given the scale and profitability of their existing fleet. Huge.
It really is. So what specific variables are driving that kind of extreme forecast? Is it just pure internal rate of return, or is it more about the certainty of those long-term cash flows?
I think it's definitely the certainty of cash flow combined with the system's flexibility. See, it's designed to be bidirectional. It offers 2.2 BCF per day capacity going west to east. That serves the new data center alley and the Texas Metroplex demand we talked about. And it also offers 1 BCF per day going east to west, which provides system resilience. The financial security part comes from the fact that over 90% of that cross-Texas capacity is already sold out through 2036. That kind of long-term commitment on a brand new, highly optimized asset, that's what drives that profitability claim. It's projected to be in service no later than Q4 2026.
Right, and building infrastructure like Hugh Brinson, feeding areas like Dallas-Fort Worth, it ties directly into that critical need for backup, for resiliency, which brings us neatly to storage. They also approved the Bethel storage expansion.
Absolutely. You hit it right there. Data centers, major utilities, they simply cannot tolerate outages or volatility, especially from things like freeze-offs, which we've seen. So the Bethel facility is set to double its working gas storage capacity to over 12 BCF, expected in service late 2028. This adds a huge layer of reliability. It really bolsters the promise they've made to those long-term power customers. It's not just a nice-to-have anymore. It's a necessary piece of this new gas supply chain. And they also noted there's potential to expand that site by another 15 BCF beyond even this current approval.
Yeah.
Lots of runway there.
Okay. We've definitely established that natural gas is, well, dominating the growth CapEx picture. Let's shift gears a little and look at how they're optimizing their existing non-gas portfolio. You know, the NGLs, crude, and general asset management strategy.
Yeah, the big headline here, I think, is strategic asset conversion. The Nederland Flexport NGL export expansion is now fully ready for ethylene export service. That kind of rounds out its capability after being placed into ethane and propane service earlier. But the truly strategic move, the one generating buzz, involves one of their Permian NGL pipelines.
Yes. I remember reading about that analysis suggesting an NGL pipeline conversion. What's the thinking there? Why do that?
Well, they're actively evaluating converting one of their existing NGL pipelines, one flowing out of the Permian entirely over to natural gas service. And the reason, it's kind of a brutal economic reality check, really. The NGL market is highly competitive right now, which is pushing down transportation rates. Their internal analysis apparently suggests that switching that pipe to natural gas service could yield potentially 2 times the revenue compared to what it earns carrying NGLs. And that's purely because of the soaring demand from this new power sector and data center contracts we've been discussing.
So basically, they're looking at the physical pipe and saying, okay, this steel is actually more valuable if it moves gas molecules than if it moves liquid molecules right now. all because the new demand pull for gas is just that much stronger. That's pure capital optimization in action.
Precisely. Just ruthlessly optimizing assets based on clear market signals. Now, moving over to crude oil, they're also focused on securing long-term Canadian flows, but it seems more like a defensive strategy there.
Okay, tell us about those Canadian crude access projects.
Right, so first, they reached final investment decision FID on the Southern Illinois Connector. That's a project set to deliver about 100,000 barrels per day of Canadian crude capacity. But maybe more crucially, they're working closely with Enbridge on the Dakota Access Pipeline, or DAPL North project. The goal there is to provide 250,000 barrels per day of Canadian crude capacity through DAPL. And importantly, these moves are backed by new 15-year contracts.
Okay, why are those 15-year terms so strategically vital for DAPL right now?
They're absolutely crucial, really, because volumes coming out of the Bakken region are generally anticipated to level off, maybe even decline slightly over time. So this isn't really a growth strategy for DAPL itself. It's an essential utilization strategy. Securing these new long-term Canadian commitments helps keep the Dakota Access Pipeline full well into the 2040s. It's basically a proactive defensive move to maintain earnings and utilization against that expected regional shift. We also saw some smaller, more targeted investments like the $75 million expansion at the Price River Terminal out in Utah. That's expected to double export capacity for American Premium Uinta, or APU, oil by Q4 2026, backed by a commitment to.
Got it. Okay, finally, let's circle back and review the capital discipline that's supposed to be underpinning all this construction. Interestingly, the 2025 growth capital guidance was actually lowered slightly, wasn't it? From $5.0 billion down to $4.6 billion. Yet we see this huge jump projected for 2026.
Yes, exactly. They did exercise some capital discipline in 2025, maybe by shedding some non-essential spending or retiming things. But the sheer number of these high-return contracted projects coming down the pike demands future investment. So they're projecting 2026 growth capital will ramp back up to approximately $5.0 billion. And as we've discussed, the vast majority of that will be invested in the natural gas value chain. Crucially, they're emphasizing that all these projects are expected to generate robust mid-teen returns. That's the benchmark.
And the big question mark that always seems to linger, Lake Charles LNG, the export terminal. Where does that stand in terms of actual capital allocation? Still waiting.
Still pre-FID, pre-final investment decision. Management sounds like they're holding quite firm on their criteria there. They need two major pieces to fall into place. First, securing 80% equity partners, MidOcean Energy, is reportedly targeting 30%. And second, converting the remaining non-binding heads of agreement into firm, binding offtake contracts. They really stress they will not commit the capital unless that project meets their strict risk-return criteria. They want to ensure Lake Charles doesn't become some kind of capital drain. Discipline is key there.
Okay, so boiling it all down, what does this really mean for you, the listener? The portfolio is stable, right? No single segment contributes more than a third of adjusted EBITDA. And about 90% of revenues are locked in via fee-based long-term contracts. That provides a solid foundation. But the massive shift, the big story, is clearly the future dominance of this contracted natural gas infrastructure build-out.
Yeah, the immense scale of the build-out is absolutely the defining theme here. It's hard to overstate. If you connect the dots between Desert Southwest, Hugh Brinson, and the other major announced expansions, we're looking at over 11 to 12 TPLFS per day of new gas demand capacity being constructed specifically out of the Permian Basin over the next few years. That capacity is going to pull production aggressively.
It really raises a fascinating, maybe even provocative thought to leave people with. If 11 to 12 BCF per day of pipeline capacity is essentially guaranteed to exist soon, and remember, much of it is backed by these 18 to 25-year contracts, what are the long-term implications for regional gas prices in the Permian? And maybe more critically, if you are a Permian gas producer right now, why aren't you urgently moving today to lock up long-term supply deals, to ensure your production can actually fill this imminent massive infrastructural pull that's coming? The analysis we saw suggested the current market might be dangerously complacent about this. It basically implied if I were the market, I would be out locking up production today. A perfect insight there into that potential disconnect between infrastructure certainty and supply commitment. Well, thank you for joining us on this deep dive into the future of energy infrastructure. We really hope this gave you the shortcut to being well informed on these major shifts.